Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of what to do during a market crash, a guide for investors. Market crashes explained, key characteristics and survival tips. Is the stock market's unpredictability keeping you up at night? You're not alone. In the blink of an eye, a market crash can send shockwaves through the global economy, impacting everything from the value of your portfolio to the prices at your local grocery store. Understanding these market crashes isn't just for the Wall Street elite, it's vital for anyone with a stake in the financial world. This video will unravel the causes behind these sudden downturns, pinpoint the warning signs, and arm you with strategies to navigate the storm. Ready to turn anxiety into action? Let's dive in. What is a market crash? Imagine driving down a steep hill and suddenly losing control, your brakes don't respond, and the speed keeps increasing. This is what a market crash feels like in the economic world. It's a rapid, sharp drop in stock prices across a significant section of the market. These dramatic declines can be sudden and severe, often leading to widespread panic among investors. Characteristics of a market crash. Market crashes can be likened to a scary roller coaster with unexpected twists and turns. They have several defining features that set them apart. Sudden price decline. The first and most obvious sign of a market crash is a quick and dramatic drop in stock prices. This isn't your typical, slow dip, it's more like plummeting down a cliff. Panic selling. As prices drop, investors start to panic and rush to sell their stocks to avoid further losses. Think of it as a crowded theater where someone yells, "Fire," and everyone dashes out at once. High volatility. During a crash, the market becomes unpredictable, with prices swinging wildly. This is when stocks feel like they're on a trampoline, bouncing up and down without any clear pattern. These features contribute to the stress and anxiety that surround market crashes. They disrupt financial plans and can lead to significant economic impacts. Distinction from other market movements. Market movements can often be confusing, much like trying to tell different shades of blue apart. Here's how a market crash stands out from other market phenomena. Market crash versus market correction. A market correction is more like a speed bump than a crash. Corrections happen when stock prices fall by about 10% from their recent highs, usually over days or weeks. They're part of the market's natural cycle and often necessary to maintain balance. In contrast, a market crash is much more abrupt and severe. Market crash versus bear market. A bear market is when stock prices decrease by 20% or more over an extended period, often months or years. It's like a long winter where the market hibernates, slowly adjusting to lower levels. A crash, on the other hand, is a sudden storm that causes chaos in a short time. Understanding these distinctions helps investors better navigate the financial landscape, allowing them to anticipate and react to changes with more clarity. By recognizing the signs and differences, you can be better prepared, even during the most uncertain times. Historical market crashes. Markets have their ups and downs, but some crashes have left marks on history. These events changed economies, reshaped policies, and taught investors valuable lessons. Let's take a closer look at some of the most significant market crashes in history and understand how they impacted the world. The Great Depression, 1929. The Great Depression was one of the most severe economic downturns ever. Imagine waking up one day and finding out that stock prices had plummeted, wiping out fortunes overnight. That's what happened in 1929 when the stock market crashed. But what led to this disaster? Causes. Among the main culprits were roaring stock speculation and easy credit. People were investing money they didn't have, hoping to get rich quick. Unfortunately, this created a bubble that inevitably burst. Events of the crash. In October 1929, panic set in, and investors rushed to sell their stocks. The markets tumbled, and by 1932, they had lost nearly 90% of their value. Banks failed, businesses closed, and unemployment soared. Long-term effects. The Great Depression taught us the dangers of unchecked speculation and economic inequality. It led to significant reforms, including the creation of the Securities and Exchange Commission, SEC, to oversee and regulate the stock market. Black Monday, 1987. The markets faced another shocking day on October 19, 1987, known as Black Monday. What could have caused such a sudden crash, and what were the outcomes? Factors leading to the crash. Several factors contributed, like market psychology, computer trading, and economic uncertainties. Fear spread like wildfire, and automated trading systems amplified the chaos. Aftermath. Markets bounced back relatively quickly, but Black Monday served as a wake-up call. It showed how technology can magnify human panic and forced policymakers to rethink how markets should be regulated. The dot-com bubble, 2000. The dot-com boom of the late 1990s was like a gold rush for tech companies. But what goes up must come down, and this bubble did just that. Rise and fall of tech stocks. In the late 90s, anything with a com seemed like a guaranteed winner. Investors poured money into tech startups without considering if they actually made money. When reality set in, the bubble burst, and stock prices collapsed. Implications for investors. Many lost fortunes, but it wasn't all bad. The crash taught important lessons about the risks of speculative investing and importance of thorough research before making investment decisions. The financial crisis, 2008. The 2008 financial crisis was a recent reminder of the vulnerabilities in our financial systems. How did this crisis unfold, and what were its far-reaching effects? Events leading up to the crash. It started with the housing market. Banks were giving out risky loans to people who couldn't afford them. When borrowers defaulted, the impact rippled through the global economy. Global repercussions. The crisis resulted in the loss of millions of jobs, and governments had to step in with massive bailouts to save banks and stabilize economies. It led to new regulations, like the Dodd-Frank Act, aiming to prevent such a crisis from happening again. These historical market crashes remind us of the unpredictable nature of financial markets and the lessons they impart about risk, regulation, and resilience. Understanding what happened helps us prepare better for future uncertainties. Causes of market crashes. Understanding why markets crash is crucial, whether you're an investor or just curious about the financial world. Think of the stock market as a complex machine with many moving parts. If one part fails, the whole thing can stop working. Several factors can cause these failures, leading to market crashes. Economic indicators and trends. Economic indicators are like the vital signs of an economy, providing clues about its health. Three major indicators play key roles in market crashes. Unemployment rates. When people lose jobs, they spend less. Less spending means businesses earn less, leading to lower profits and falling stock prices. Inflation. This is when prices keep going up. Sounds simple, right? But if prices grow too fast, people can't buy as much, and that hurts businesses. It's like trying to run a marathon wearing shoes that are 2 sizes too small. Interest rates. These are the costs of borrowing money. When rates go up, loans get more expensive, which can slow down spending on big-ticket items like houses and cars. This slowdown ripples through the economy. Each of these factors can create stress in the market, much like a storm cloud signaling a coming storm. Psychological factors. Humans aren't always rational, especially when it comes to money. Emotions can drive market behavior even when logic says otherwise. Here are a few psychological factors at play. Investor sentiment. If everyone believes the market will rise, they're likely to buy more stocks, which pushes prices up. But if the mood shifts, panic can spread faster than a rumor in a high school cafeteria. Fear and greed. These two emotions are often seen as the primary drivers of financial behavior. Greed can lead to bubbles, where asset prices get too high. Fear can lead to sell-offs, where people dump stocks in a race to the bottom. Investors sometimes act like a herd of stampeding cattle. One startled cow can lead the whole herd into a frenzy. Global events and their impact. Beyond economics and psychology, world events can create shockwaves that shake markets. Sometimes, these events are unpredictable, making them even more unsettling. Geopolitical tensions. Conflicts between countries or political uncertainty can disrupt trade and affect global supply chains, leading to economic downturns. Natural disasters. Earthquakes, hurricanes, and other disasters can destroy infrastructure and halt economic activities. Pandemics. The COVID-19 pandemic is a recent example where global health emergencies stalled economies and caused major market crashes. Each of these events can act like a domino, knocking over one piece after another until the whole line falls. When you look at all these causes together, it becomes clear that market crashes are rooted in a mix of economic signals, human behavior, and global events. Understanding these can help us prepare for future market changes. The role of technology in market crashes. Technology has undeniably changed how financial markets operate. But with progress comes potential pitfalls. In times of market stress, technology can act like a double-edged sword, quickening the pace of market crashes. Let's explore how algorithmic trading and social media influence these situations. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.